$500,000 can produce about $1,667 a month from a retirement portfolio. $1 million can produce about $3,333 a month. The concrete difference is $1,667 every month, or $20,000 a year. So yes, under textbook retirement math, doubling the portfolio doubles the portfolio paycheck. That arithmetic works perfectly. The surprise is that your portfolio paycheck is not your entire retirement lifestyle, and those two things become less connected once. Social Security, taxes, withdrawal behavior, market timing, and the number of years ahead are added to the ledger. Picture two columns, $500,000 on the left, $1 million on the right. Beneath both, there will eventually be reliable income, such as Social Security. Running through both will be taxes. And above everything sits the number that matters more than either balance, the portfolio's job. The portfolio's job is the amount of annual spending your investments must cover after reliable income. Divide that amount by your balance and you get the pressure placed on the account. That pressure is where the additional $500,000 earns its value. For the moment, the left column pays $20,000 a year. The right column pays $40,000. Those figures come from applying a 4% starting withdrawal to both accounts. The 4% framework begins with 4% of the original portfolio in the first retirement year. After that, the retiree generally increases the dollar withdrawal with inflation rather than recalculating 4% of the new balance every year. It was designed to create something resembling an inflation-adjusted paycheck. William Bengen's original research in 1994 reconstructed historical retirements and found that a starting withdrawal a little above 4% had survived at least 30 years in the historical periods he tested. The later Trinity research found that a 4% inflation-adjusted withdrawal succeeded in roughly 95% or more of many 30-year historical scenarios, depending on the stock and bond mix. That is useful research. It is not a contractual promise from the market, and the distinction is mildly annoying because the slogan survived while the assumptions disappeared. The framework assumes a particular portfolio, a particular withdrawal pattern, a roughly 30-year horizon, historical United States returns, and no guarantee about how comfortable the journey will feel. An account that finishes year 30 with $1 technically succeeded. A retiree who watched the balance collapse and cut every enjoyable expense along the way might use a less flattering word. Current forward-looking research modifies the opening numbers slightly. Morningstar's retirement income research for new retirees in 2026 estimates a 3.9% starting rate for someone seeking stable inflation-adjusted spending over 30 years. Using a diversified portfolio and a 90% probability of having money remaining. At 3.9%, $500,000 produces $19,500 a year, or $1,625 a month. $1 million produces $39,000 a year, or $3,250 a month. The monthly difference becomes $1,625. That is barely smaller than the 4% result. Updating the percentage has not solved the puzzle because we are still calculating what the portfolio may support, not what retirees tend to use. Withdrawal method also changes the answer. Morningstar found that flexible approaches could support initial rates as high as 5.7% in some modeled cases. On $500,000, that begins at $28,500 a year. On $1 million, it begins at $57,000. That higher opening income comes with a condition attached. Spending must be allowed to move. A weak market may require a smaller raise, no inflation increase, or an actual cut. The higher rate is not free income. It transfers some risk away from account depletion and into the amount you can spend next year. I built a digital book called The Exit Code, partly because the difference between a fixed withdrawal and a dynamic one can completely change your retirement date. It explains the 4% trap and the withdrawal framework I use, and it is available through the link in the description. Capacity is one side of the ledger. Behavior produces a very different set of numbers. Research by David Blanchett and Michael Finke used health and retirement study data to examine how retirees actually draw from savings. Their estimated withdrawal rate for married households at age 65 with at least $100,000 in financial assets was approximately 2.1%. For single households, it was around 1.9%. That 2.1% figure is an average for a defined research group, not a prescription for you. Some households withdraw far more. Others barely touch their accounts. But it gives us a qualified illustration of what observed behavior can look like, rather than what a textbook allows. Apply 2.1% to the two columns. The $500,000 account pays $10,500 a year, or $875 a month. The $1 million account pays $21,000 a year, or $1,750 a month. The observed behavior gap is now $875 a month. It is $10,500 a year, not $20,000. The portfolio still doubled. The theoretical income still scaled with it. Actual withdrawal behavior compressed the difference by almost half because the household with more assets did not automatically convert all of that additional capacity into current consumption. That can look irrational. You worked for decades to accumulate money, reached retirement, and then became reluctant to spend it. Congratulations, your brain has changed the assignment after you completed it. There is a credible explanation. Researchers describe a retirement spending puzzle in which people are more willing to spend income than savings. Social Security feels like a paycheck. A pension feels like a paycheck. Interest and dividends often feel spendable. Selling a piece of your portfolio can feel like dismantling the safety net. Economically, dollars are interchangeable once taxes are considered. Psychologically, they arrive wearing different uniforms. If $3,000 enters your checking account from Social Security, your brain labels it monthly income. If you must sell $3,000 from an investment account, your brain sees the account balance fall. The first transaction feels renewable. The second feels irreversible, even when a sustainable retirement plan was designed around withdrawals. That means the $1 million household often retains more money rather than immediately living a radically more expensive life. The additional balance becomes margin, optional spending, a future reserve, or an inheritance that may not have been part of the original plan. By the way, subscribing helps the channel more than you might expect, so thank you to everyone who clicks it. Now add the largest shared foundation for many American retirees. Social Security estimates that the average monthly benefit for an aged couple, with both people receiving benefits in 2026, is $3,208. That is a national average, not an estimate of your personal benefit. Your amount depends on earnings history, claiming age, marital circumstances, and other rules. We are using it to isolate the effect of adding the same reliable income foundation beneath two different portfolios. Put $3,208 under the $500,000 column, then add the observed withdrawal illustration of $875. Gross monthly resources become approximately $4,083. Put the same Social Security amount under the $1 million column, then add $1,750 from the portfolio. Gross monthly resources become approximately $4,958. These figures combine separate verified averages for illustration. They are not a published description of one representative couple. The arithmetic is showing the mechanism. The portfolio rose by 100%. Illustrated gross monthly resources rose by about 21%. That is why the normal lifestyles can look surprisingly close. Both households may live in the same paid-off home, shop in the same stores, drive similar cars, watch the same television, and spend Wednesday morning wondering why the pharmacy has reorganized every aisle again. The $1 million household has $875 more gross cash flow each month under this behavioral illustration. That is meaningful. It can fund more travel, restaurants, gifts, hobbies, home maintenance, or fewer moments of staring suspiciously at the grocery receipt. It is not twice the lifestyle. Reliable income compresses the gap because it does not automatically double with investment assets. Social Security is based on your covered earnings and claiming choices, not the balance of your brokerage account. A disciplined saver and an enthusiastic spender with similar lifetime earnings can receive similar Social Security benefits while entering retirement with very different portfolios. The extra $500,000 has not become unimportant. It has changed categories. part supports additional current spending. The rest sits behind the lifestyle as retained capacity. During a normal month, retained capacity looks uneventful. Retirement is not made dangerous by normal months alone. Fidelity updated its retiree healthcare estimate on July 21st, 2026. It now estimates that a 65-year-old retiring in 2026 may spend an average of $185,500 on healthcare and medical expenses throughout retirement. That estimate is for one person, not a couple. It assumes original Medicare Parts A and B and Medicare Part D. It includes premiums, co-payments, deductibles, co-insurance, and certain out-of-pocket prescription and medical costs. It excludes potential long-term care costs, over-the-counter medications, and most dental services. It is also not a bill arriving on retirement day. The expenses occur over time. Its role in our ledger is to show that large retirement burdens do not politely shrink because your portfolio is smaller. A $500 monthly spending difference can feel modest. A major dental procedure, extended care need, damaged roof, family emergency, or sustained increase in insurance costs arrives as a dollar amount. The larger account can absorb the same dollar shock while sacrificing a smaller percentage of itself. That is the beginning of the real advantage. The extra capital does not necessarily purchase a different Tuesday. It purchases more ways for Tuesday to go wrong without changing the rest of your year. Gross account balances still overstate what either household can spend because a portfolio dollar has no universal tax value. Imagine both columns display exactly the same balance, but one account is mostly traditional 401k money and the other contains a mix of taxable brokerage assets, Roth assets, and tax-deferred savings. Those households do not possess the same after-tax retirement. Withdrawals from a traditional IRA or traditional 401k are generally taxed as ordinary income, except for any applicable after-tax basis. Qualified Roth withdrawals generally are not included in gross income. In a taxable brokerage account, selling an investment is not automatically the same as realizing that entire sale amount as income. The taxable gain is the sale proceeds above your cost basis. You might sell $50,000 from a brokerage account and realize only $15,000 of gains. Another retiree might withdraw $50,000 from a traditional IRA and create close to $50,000 of ordinary income. The bank accounts can receive the same cash, while the tax returns tell two different stories. For 2026, the top of the 0% federal long-term capital gains bracket is $98,900 of taxable income for married couples filing jointly. For single filers, it is $49,450. Those are taxable income thresholds, not limits on how much cash can leave a brokerage account. Cost basis, deductions, ordinary income, and the character of the gain all matter. State taxes may produce another result. Ordinary income also occupies the lower part of the tax stack before long-term gains are layered on top. Social Security can become partly taxable depending on combined income. Traditional account withdrawals can consume space that might otherwise have been available for gains at 0%. So the $1 million household does not automatically receive twice the after-tax lifestyle. If much of that million is tax-deferred, while the smaller portfolio is more tax-diversified, the spendable gap can narrow. Reverse the account composition, and it can widen. After more than a decade running my own business and spending an unreasonable amount of time around accountants and fiscal lawyers, this is the recurring lesson. The number on the statement is rarely the number you control. Money moves through rules, and the rules determine how much lands in your life. The timing of those rules matters because tax flexibility changes with age. Required minimum distributions generally begin at age 73 for many current retirees. The applicable age rises to 75 for people born in 1960 or later. Traditional retirement accounts can eventually produce mandatory ordinary income, whether you need the entire distribution for spending or not. Original Roth IRA owners do not face lifetime required minimum distributions from those Roth IRAs. That creates a planning window between leaving work and the start of mandatory distributions. Lower earned income during those years may leave room to realize gains, draw from selected accounts, or convert tax-deferred money while controlling the resulting tax bill. The larger portfolio gives you more assets, but a larger tax-deferred balance may also create larger future mandatory distributions. Those distributions can crowd capital gains into higher brackets and increase modified adjusted gross income. Medicare adds another charming layer of paperwork. In 2026, income-related premium adjustments begin above modified adjusted gross income of $109,000 for many individual filers and $218,000 for married couples filing jointly. Social Security typically uses tax information from 2 years earlier. Crossing a threshold can increase Medicare Part B and prescription drug premiums. The effect is not that earning an extra dollar destroys your retirement. The effect is that withdrawal order can alter the net value of that dollar, sometimes years after the decision was made. The static ledger now contains income, behavior, health costs, and taxes. It is still missing the variable that can permanently alter both columns even when the long-run investment return looks fine. Return order. Suppose your portfolio earns a strong average return over 12 years. If you are still accumulating and making contributions, the order of annual returns matters, but ongoing deposits can help. Once you are withdrawing, negative returns near the beginning carry a second cost. The market reduces the account, then your spending removes assets from that reduced account. Those assets are no longer present when the recovery comes. Take a $1 million portfolio that falls 20%. It is now worth $800,000. If you withdraw $40,000, the remaining balance is $760,000. Returning from $760,000 to $1 million requires a gain of more than 31%. Without the withdrawal, $800,000 requires a 25% gain to recover. Your grocery bill did not cause the market decline, but funding it while the account was down raised the recovery hurdle. Now apply that mechanism to both columns while holding the dollar lifestyle constant. A $20,000 annual portfolio job consumes 4% of $500,000. It consumes 2% of $1 million. If both portfolios lose 20%, the balances become $400,000 and $800,000. The next $20,000 withdrawal now consumes 5% of the smaller account and 2.5% of the larger one. The same lifestyle, the same market loss, and the same dollar withdrawal create twice the percentage burden on the smaller portfolio. That changes the recovery path. It also changes the available choices. The $500,000 retiree may need the entire withdrawal for core spending. The $1 million retiree funding the same life may have room to skip an inflation increase, reduce discretionary expenses, draw from another tax bucket, or leave more assets invested. PIMCO illustrated the force of return order with two retirement paths, beginning with $1 million in a 60% stock and 40% bond portfolio. The paths use the same returns in different orders over 12 years. One path finished at roughly $1.2 million, the other finished near $1.7 million. The difference exceeded $460,000, created by sequence rather than a better average return. That divergence is almost as large as the entire opening gap between our two retirees. The comparison changes what the $1 million target means. It is not primarily a ticket to spend twice as much. It can be protection against receiving the wrong returns at the wrong time while your life continues sending invoices. The mainstream retirement slogan compresses all of this into a suspiciously tidy instruction. Maximize your 401k. Reach a large round number. Withdraw 4% and wait until your mid-60s. The advice is not useless. It is incomplete in the exact phase when errors become hardest to repair. An accumulation balance tells you how much you own. It does not tell you which dollars are taxable, how spending reacts to losses, how much reliable income covers, or whether your withdrawal method survives your particular timeline. A rule designed to test historical survival somehow became a universal spending plan. Finance has a talent for taking a useful research result and sanding off every warning label. Knowing these numbers and building a system around them are two different jobs. I built a digital book called The Exit Code as an analysis of 50 years of retirement data distilled into a mathematical framework for exiting the rat race. It explains the 4% trap and the dynamic withdrawal method that replaces a rigid paycheck with rules for adapting spending before a bad sequence becomes permanent. It also covers tax diversification because a portfolio split across taxable, tax-deferred and Roth money can give you far more control than the same balance trapped in one tax bucket. The goal is to turn maybe someday into a specific date supported by actual cash flow math. You can get it for less than a dinner out through the link in the description. Every year you delay the calculation is another year in which taxes, market returns, and your time horizon keep moving without a coordinated plan. Morningstar's current research gives the early retirement years an especially useful checkpoint. In its 30-year simulations, nearly 70% of the failed retirement paths involved portfolios that had lost value by the end of year 5. That does not mean every portfolio down after 5 years will fail. It means early losses appear disproportionately often among the failures. Year 5 is not a magical cliff. It is a point where the interaction between returns and withdrawals has had enough time to change the account's condition. By then, the portfolio has either gained breathing room, remained under pressure, or lost assets while continuing to fund spending. The left and right columns now have histories. $500,000 is no longer only a balance. It is a balance that may have sold a larger fraction of itself through the first decline. $1 million is no longer only a bigger number. For the same portfolio job, it has retained more units of investment for potential recovery. Notice that this does not make the larger account invincible. $1 million retiree spending $57,000 under a flexible 5.7% starting approach can place more pressure on the portfolio than a $500,000 retiree who needs $10,000. Balance alone never determines safety. The job assigned to the balance does. This is where withdrawal flexibility becomes practical rather than academic. Morningstar's 3.9% base case aims for a steadier, inflation-adjusted paycheck. The modeled flexible approaches that begin as high as 5.7% accept more variation in annual cash flow. If your starting portfolio is $1 million, the difference between those rates is $18,000 in the first year. That can feel like a free upgrade from $39,000 to $57,000. The cost appears in weak conditions. A flexible method may require spending to fall when the account declines. The portfolio becomes more durable, partly because your lifestyle absorbs part of the volatility. A fixed method asks the investments to protect the paycheck. A dynamic method asks the retiree and the investments to share the adjustment. Neither arrangement is morally superior. They solve different problems. If nearly all your spending covers housing, food, utilities, insurance, and medical costs, your flexibility may be limited. If reliable income covers those essentials and portfolio withdrawals fund travel and gifts, variable spending may be far easier. That is why reliable income does more than raise the total monthly number. It determines how much of the portfolio job is negotiable. Imagine your household needs $60,000 a year after accounting for taxes. Reliable income provides $40,000. The portfolio job is $20,000. Perhaps $15,000 of that portfolio job covers property taxes, insurance, and necessary home maintenance. The remaining $5,000 funds discretionary travel. In a bad market, only the $5,000 can comfortably move. Your effective flexibility is not $20,000. It is $5,000. The $1 million account can fund the full $20,000 job at 2%. The $500,000 account requires 4%. If discretionary spending falls by $5,000, the rates become 1.5% and 3%. Both improve. The smaller account receives the larger proportional benefit from the spending cut because every saved dollar represents more of its balance. Yet it may have less lifestyle room available to make that cut. That is the uncomfortable trade. The household most exposed to sequence risk may also be the household with fewer discretionary expenses to remove. Time adds the remaining pressure. The historical 4% conversation usually focuses on roughly 30 years. Someone retiring at 65 and planning through age 95 fits that window. Someone leaving work at 55 may need the portfolio to carry a materially longer assignment. You cannot take a 30-year result, stretch the timeline by another decade or two, and assume the same conclusion. A longer retirement means more withdrawals, more inflation adjustments, more opportunities for bad sequences, and more years before reliable income may begin. That does not produce one universal replacement rate. Your asset mix, spending flexibility, reliable income dates, tax structure, and desired ending balance affect the answer. The honest conclusion is directional. The longer the job, the more pressure a given starting withdrawal places on the account. $1 million at age 70 with strong Social Security and a paid-off home is not performing the same job as $1 million at age 50, with children at home, private health coverage, and 15 years before full retirement benefits. The statement balance is identical. The assignment is completely different. This is also why chasing $1 million can become a brain problem. Round numbers are emotionally satisfying because they remove the need to define the life. You can measure progress towards 7 figures without deciding what you want Tuesday afternoon to cost. Your account balance is visible. Future spending is messy. Social Security involves claiming decisions. Taxes involve account types. Healthcare involves uncertainty. Markets refuse to provide a schedule. So your brain chooses the cleanest target and calls it the plan. I have multiple hundreds of thousands of dollars invested, so I understand the appeal. Watching the number grow feels like control. Spending from it later requires